There's a pattern in financial history that has protected wealth through every major collapse in modern history. And right now in 2025, most people are doing the exact opposite of what this pattern says to do. Three nations proved these rules work. China survived its century of humiliation and complete currency collapse in 1948. Japan survived its lost decades after the 1989 asset bubble implosion, and Switzerland has survived both world wars, the Great Depression, and every financial crisis since 1850. These aren't theories posted on financial forums or strategies from investing books. They're survival patterns extracted from real collapses, where 90% of people lost everything and 10% got wealthier. The difference wasn't luck, education, or inside information. It was following 7 specific rules that work when everything else fails. Here's what people don't understand about collapse. During China's hyperinflation in 1948 and 1949, the currency didn't gradually decline. It vanished. In January 1948, 3 yuan bought 1 US dollar. By December 1948, 12 million yuan bought 1 US dollar. Families watched their life savings become worthless in months. When Japan's asset bubble burst in 1989, the Nikkei stock index fell 60% in 3 years. Tokyo real estate, once valued higher than all property in the United States combined, dropped 80%. It took 35 years for the Nikkei to return to 1989 levels. 35 years. An entire generation spent recovering. But some families didn't just survive these collapses. They thrived. Shanghai merchants who converted to gold before 1948 maintained wealth at a 100-to-1 advantage over those who held currency. Japanese investors who kept liquidity bought Tokyo properties at 20 cents on the dollar in the late 1990s and made fortunes. Swiss families maintained wealth through both world wars, while their neighbors lost everything. By the end of this, you'll know the exact 7 rules these families followed. Let's start with the most extreme example. China, 1948, when an entire currency ceased to exist in 12 months. China emerged from World War II exhausted but intact. The nationalist government controlled the world's most populous nation, commanded millions of troops, and held international recognition. But beneath the surface, the economy was already dying. The government was fighting a civil war against communist forces and needed money desperately. They did what every failing government does. They printed currency, mountains of it. In January 1948, 3 Chinese yuan equaled 1 US dollar. The government assured citizens the currency was stable, backed by reserves, protected by policy. They were lying, or they were deluded. The result was the same. By August 1948, the collapse was undeniable. The government introduced the gold yuan to replace the collapsing currency, promising this new money would hold value. It was backed by gold, they said. It was limited in supply, they claimed. Within months, the gold yuan was worthless. By December 1948, 12 million gold yuan bought 1 US dollar. Hyperinflation hit 5,000% annually. In Shanghai, rice prices doubled daily. Workers received wages in the morning and sprinted to markets because by afternoon, the money bought half as much. Families carried currency in wheelbarrows, not because they were rich, but because they needed massive volumes to buy necessities. Life savings accumulated over generations evaporated in weeks. But some families survived. They understood rule number 1. Store wealth in what governments cannot print. The Shanghai merchant families who converted paper currency to physical gold, silver, and jade maintained their wealth. While their neighbors watched bank accounts become worthless, these families held assets no government could debase by decree. The conversion rate told the story. Families who moved to gold in early 1948 preserved wealth at 100 times the value of those who trusted currency. The government could print infinite yuan, infinite gold yuan, infinite paper promises. They could not print gold. They could not print silver. They could not manufacture jade. Physical precious metals existed in fixed quantities, and that scarcity protected value when everything else collapsed. The key was timing. By the time everyone recognized the collapse, it was too late. The families who survived acted before the crisis became obvious, when their neighbors still believed government assurances, when holding currency still felt safe. They understood that waiting for certainty meant waiting until conversion was impossible, but precious metals alone weren't enough. These families also understood rule number 2: own productive assets, not paper promises. The families who owned farmland and factories, physical production capacity, maintained wealth because they controlled necessities. A farm produces food regardless of what happens to currency. A factory produces goods people need. These assets generated value in any economic environment. Meanwhile, paper assets dissolved. Government bonds promised future payment in worthless currency. Stocks in state-backed companies became certificates of nothing when those companies ceased operating. Bank deposits vanished when banks collapsed. The families who owned productive physical assets could still generate food, manufacture goods, create value. City workers who held only salary claims and bank deposits starved. Rural landowners ate. That was the difference. One group owned paper promises, dependent on governmental and institutional stability. The other group owned physical assets that produced regardless of political chaos. When the nationalists fled to Taiwan in 1949, the paper wealth holders discovered their assets were claims on a government that no longer existed. The landowners still had land. But even productive assets in China weren't completely safe, which revealed rule number 3: diversify across borders, not just asset classes. The wealthiest families, the ones who maintained power through the collapse and beyond, moved portions of their wealth outside China before 1948. They opened accounts in Hong Kong banks, transferred assets to Singapore, moved capital to the United States. When the communist government seized private property in 1949, these families lost their Chinese holdings but maintained wealth elsewhere. Geographic diversification protected against single government collapse. The Sung family, connected to nationalist leadership, moved wealth offshore before the final crisis. When the nationalists lost the mainland, the Sungs remained wealthy because their assets weren't concentrated in one jurisdiction. This wasn't about predicting exactly when or how collapse would occur. It was about understanding that concentration creates vulnerability. Every asset held in one country is a bet on that country's stability, its government's competence, its currency's survival. The families who spread wealth across multiple nations protected against catastrophic loss. Those who kept everything in China, trusting that their homeland was eternal, lost everything. By 1949, China had a new government, a new economic system, and effectively a new currency. Anyone who followed these 3 rules, store wealth in scarce physical assets, own productive property, and diversify geographically, maintained wealth through complete systemic collapse. Everyone else started from zero. Those Shanghai families who converted to gold, owned productive assets, and moved wealth offshore, their descendants are still wealthy today, 75 years later. The families who trusted paper currency and government promises, their wealth vanished in 12 months and never returned. Now let's jump forward 40 years to Japan, 1989, where a different kind of collapse taught the world 3 more rules. Japan, in 1989, stood at an economic peak so extreme it seemed to defy gravity. The nation was the world's second largest economy. Its corporations were buying American landmarks like Rockefeller Center and Pebble Beach Golf Resort. And Tokyo real estate had reached valuations so absurd that the grounds of the Imperial Palace were theoretically worth more than all the land in California combined. The Nikkei stock index hit 38,915 on December 29, 1989. Economists declared Japan would overtake the United States as the world's dominant economy within a decade. Japanese banks were the largest in the world. Japanese manufacturing was the global standard. The rising sun seemed unstoppable, but beneath the celebration, an asset bubble of historic proportions was about to detonate. The collapse came fast. By 1992, just 3 years later, the Nikkei had fallen 60% to around 15,000. Real estate, the asset class Japanese families believed was immune to decline, dropped even harder. By 2003, Tokyo property values had fallen 80% from their 1989 peak. Banks held over $1 trillion in non-performing loans, debt that would never be repaid because the collateral behind it had evaporated. The result was 2 lost decades, 1990 to 2010, where the Japanese economy experienced essentially zero growth. An entire generation entered the workforce, built careers, raised families, and retired while their economy stayed frozen. Stock portfolios bought at the peak in 1989 didn't recover until 2024, 35 years of waiting just to break even. But some families didn't wait 3 decades to recover. They understood rule number 4. Never confuse a bubble with permanent wealth. The families who sold real estate in 1988 and 1989, who took profits near the market peak and moved capital into bonds and foreign assets, preserved their wealth completely. They recognized something their neighbors refused to see, that when everyone believes prices only go up, you're not in a normal market, you're in a bubble. The indicators were everywhere. Japanese corporations were borrowing money to buy assets completely outside their core business. Real estate companies were buying golf courses in California. Electronics manufacturers were purchasing Hollywood studios. Banks were lending against property at valuations that assumed infinite appreciation. And individual families were doing the same thing, borrowing against their inflated homes to buy more real estate, convinced that land prices in Japan never fell. The mathematics were simple but brutal. When asset prices fall 80%, anyone who borrowed against those assets at peak valuations owes more than the assets are worth. Japanese families found themselves trapped. They couldn't sell without realizing catastrophic losses. They couldn't borrow more because banks wouldn't lend against declining collateral. They couldn't wait it out because the decline lasted decades. The families who survived were those who sold before the collapse became undeniable. They took profits when their neighbors called them foolish for selling appreciating assets. They recognized the signs. When taxi drivers offered stock tips, when salaries at financial firms tripled in 2 years, when leverage accelerated across the entire economy. These weren't signs of permanent prosperity. They were signs of terminal speculation. The key mathematical truth these families understood was reversion to mean. Asset prices can stay elevated for years, but they always eventually return to historical averages relative to incomes, rents, and economic fundamentals. Tokyo real estate in 1989 was trading at 100 times normal ratios. That wasn't a new paradigm. It was a bubble. Rule number 4 said sell. But selling alone wasn't enough. These families also understood rule number 5. Maintain liquidity through transitions. The Japanese investors who not only sold near the peak, but kept 20% to 40% of their wealth in cash and cash equivalents, were positioned to do something remarkable when the collapse came. They could buy. When Tokyo real estate crashed 80%, when stocks fell 60%, when desperate sellers flooded the market, the families with liquidity stepped in and purchased assets at 20 cents on the dollar. Real estate investors who maintained cash reserves bought premium Tokyo properties in 1995 through 2003 at discounts that seem impossible today. They bought office buildings in Ginza, apartments in Shibuya, commercial properties in Shinjuku, at prices that would never be seen again. This is the critical insight most people miss about collapse. The wealth doesn't disappear, it transfers. It moves from people who are fully invested at the peak to people who have liquidity at the bottom. The Japanese families who kept cash didn't just preserve wealth, they multiplied it by 10 times or more by buying collapsed assets. Those who were 100% invested at the peak, who believed keeping any cash was wasting opportunity because assets only appreciate, stayed broke for decades. They had no capital to deploy when everything went on sale. They could only watch as the families with liquidity bought generational wealth at liquidation prices. The mistake was believing that being fully invested was always optimal. In stable markets, maybe. But through transitions, liquidity equals optionality. Cash gives you choices. You can wait. You can buy when others must sell. You can capitalize on fear and desperation. The families who maintained 20% to 40% liquidity had the freedom to act when everyone else was paralyzed. Those who maintained zero liquidity had no options at all. The Nikkei didn't return to its 1989 peak until 2024. Japanese families who followed Rules 4 and 5 bought the collapse and built fortunes. Everyone else spent 35 years recovering. But there's one nation that hasn't just survived one collapse. They've survived every collapse for 700 years, and they didn't do it by accident. Switzerland isn't a military superpower. It has no nuclear weapons, no carrier groups, no empire. It controls no oil fields, mines no rare earth minerals, grows limited food. By conventional measures of power, Switzerland should be irrelevant. Yet, since 1850, through 2 world wars, the Great Depression, the 1970s inflation crisis, the 2008 financial collapse, and the COVID economic disruption, Switzerland has not only survived, it has thrived. While neighbors fought and bled and rebuilt from rubble, Switzerland maintained stability. While currencies across Europe hyperinflated and collapsed, the Swiss franc strengthened. While banks in London, New York, and Tokyo failed, Swiss banks endured. This isn't luck sustained for 175 years. This is a system built on rules that work when everything around them fails. The survival record is remarkable. During World War I from 1914 to 1918, Switzerland remained neutral while Europe tore itself apart. The Swiss franc stayed stable, while the German mark, the French franc, and the British pound weakened paying for war. During the Great Depression from 1929 to 1939, Swiss banks survived when American and European institutions collapsed by the thousands. During World War II from 1939 to 1945, Switzerland was the only nation in Europe whose currency maintained value, while governments fell and economies disintegrated. In the 1970s, when the United States abandoned the gold standard and inflation ravaged the dollar, the Swiss franc appreciated. In 2008, when Lehman Brothers failed and the global financial system nearly imploded, Swiss banking remained functional. In 2020, when COVID lockdowns devastated economies worldwide, Switzerland recovered faster than any comparable nation. 700 years of political stability, a currency that has strengthened across centuries, a banking system that survives every crisis. How? Rule number 6. Decentralize everything: power, risk, and storage. Switzerland operates as a confederation of 26 cantons, which function like independent states. Each canton maintains substantial autonomy over taxation, spending, and regulation. There is no single centralized power that can make catastrophic decisions affecting the entire nation. If one canton mismanages its finances, the others continue functioning. If one bank fails, the system survives because risk isn't concentrated. This federal structure creates resilience through redundancy. There is no single point of failure because there is no single point of control. Wealthy Swiss families apply this principle to personal wealth management. They don't keep all assets in one bank. They maintain accounts in 3 or more institutions, so if one fails, the others preserve capital. They don't store wealth in one country. They hold assets across multiple jurisdictions, so political instability in any single nation doesn't destroy everything. They don't concentrate in one currency. They keep franc, dollar, euro, and other denominations, so currency collapse in any one. System doesn't eliminate purchasing power. They don't hold only one asset class. They own real estate, precious metals, stocks, bonds, and businesses, so collapse in any single market doesn't wipe out wealth. Decentralization means that failure in one area becomes inconvenient rather than catastrophic. The numbers prove it works. During the 2008 financial crisis, Swiss families with decentralized wealth, spread across multiple banks, countries, and asset classes, lost an average of 15%. Families with concentrated wealth, everything in one institution or one market, lost 50% or more. The difference wasn't sophistication or inside information, it was structure. Decentralization protects against the catastrophic single points of failure that destroy concentrated wealth. But decentralization alone doesn't explain 700 years of survival. Swiss families also follow rule number 7. Stay neutral, stay liquid, and stay private. Switzerland's national neutrality doctrine, refusing to take sides in conflicts, has protected it from wars that devastated neighbors. The wealth application is identical. Don't bet everything on one political outcome, one government, one economic system. Stay neutral means maintaining optionality regardless of what happens politically. Stay liquid means keeping 20% to 40% in assets that can be sold immediately. Swiss families maintain higher cash reserves than families in any other developed nation because liquidity provides freedom. When everyone else is panicking and selling, liquid families can buy. When opportunities appear suddenly, liquid families can act. Those without liquidity can only watch. Stay private means protecting wealth from visibility that invites confiscation. Swiss banking secrecy laws, which existed until recent international pressure, forced partial disclosure, allowed families to shield assets from governments, competitors, and criminals. During World War II, families with Swiss accounts protected wealth from both Nazi, Germany, and the Allied powers. The principle remains: governments confiscate visible wealth. They cannot confiscate what they cannot find or reach. Modern application means using legal structures like trusts, foundations, and international accounts to maintain privacy within legal boundaries. Not tax evasion, but legal optimization that protects assets from governmental overreach. Every major economic collapse includes government confiscation. China in 1949 seized private property. Argentina in 2001 froze bank accounts. Cyprus in 2013 confiscated deposits above certain thresholds. The families who maintained private, internationally diversified structures preserved wealth. Those whose assets were visible and concentrated lost everything. Switzerland hasn't collapsed because these 7 rules are embedded in the culture, the legal system, the financial structure, and the national psychology. Swiss families maintain wealth across generations, not through speculation or timing markets, but through following principles that survive every crisis. 3 nations, 3 collapses, 7 rules. Now here's what should terrify you about right now. Right now in 2025, we are seeing the exact conditions that preceded all 3 collapses, and most people are doing the opposite of what the 7 rules say to do. The United States M2 money supply, the total amount of currency in circulation, has increased 40% since 2020. The Federal Reserve printed $5 trillion in 2 years to fund deficits and stimulus programs. That's the China 1948 pattern, printing currency to fund unsustainable spending. The U.S. stock market sits at record valuations by nearly every historical measure. Real estate prices in major cities have hit all-time highs. Margin debt, money borrowed to buy stocks, reached record levels in 2021 and remains elevated. Retail investors pile into speculative assets, meme stocks, cryptocurrencies with no underlying value, technology companies with no profits. That's the Japan 1989 pattern, terminal speculation dressed up as inevitable progress. And 95% of Americans hold 100% of their wealth in U.S. jurisdiction, denominated in U.S. dollars, subject to U.S. government decisions. That's the opposite of Switzerland's geographic diversification, concentration risk at maximum. Let me show you how the 7 rules apply right now. Rule number 1. Store wealth in what governments cannot print. The U.S. government holds $36 trillion in debt and adds another trillion every 100 days. Real interest rates, after accounting for inflation, are negative. When the government pays 4% on bonds, but inflation runs between 3% and 7%, savers lose purchasing power holding dollars. The response is holding 10% to 20% of wealth in assets governments cannot create by decree. Physical gold, physical silver, Bitcoin, which has a hard cap of 21 million coins that cannot be increased regardless of political pressure. These are scarce assets that maintain value when currency debasement accelerates. Rule number 2. Own productive assets, not paper promises. Government bonds yielding 4% when real inflation exceeds that rate guarantee losses. The alternative is assets that produce cash flow in any currency environment. Rental properties that generate income. Businesses that produce goods and services people need. Farmland that grows food regardless of what happens to financial markets. These assets create value independent of government promises or monetary policy. Rule number 3. Diversify across borders. Holding everything in one country means betting that country's government remains stable, competent, and solvent. That's a single point of failure. The action is opening foreign bank accounts, buying international real estate, owning foreign stocks, maintaining assets in multiple jurisdictions. If U.S. policy fails, if the dollar weakens dramatically, if political instability emerges, geographically diversified wealth survives. Rule number 4. Never confuse a bubble with permanent wealth. Right now, the mantras are everywhere. Stocks only go up. Real estate never falls in desirable cities. Artificial intelligence will change everything, so current valuations don't matter. These are the same statements Japanese investors made in 1989 before 35 years of losses. The indicators of bubble conditions are present. Retail investor participation at extremes. Speculation in assets with no cash flows. Debt accelerating to buy appreciating assets. Valuations at historical peaks by price-to-earnings ratios, price-to-sales ratios, market capitalization relative to GDP. When everyone believes prices cannot fall, that's when risk is highest. The families who survive take profits, reduce exposure, increase cash positions before collapse becomes obvious. Rule number 5. Maintain liquidity. Keep 20% to 40% of wealth in cash or cash equivalents, assets that can be sold immediately without significant loss. This feels wasteful when markets rise every year, but liquidity provides optionality. When the correction comes, and corrections always come, liquidity allows buying assets at 50 to 80% discounts. Those fully invested can only watch their portfolios decline. Those with liquidity capitalize on fear. Rule number 6. Decentralize everything. Don't keep all assets in one brokerage account, one bank, one country. Multiple institutions, multiple jurisdictions, multiple currencies, multiple asset classes. Single points of failure become single points of collapse. Rule number 7, stay neutral, stay liquid, stay private. Don't bet everything on one political outcome or governmental system. Maintain privacy through legal structures, trusts, limited liability companies, international arrangements that optimize taxes within legal boundaries, and protect assets from visibility that invites confiscation or targeting. These aren't theoretical principles debated in finance. Courses. In China, families had 12 months from stability to total currency collapse. In Japan, 3 years from peak to devastation. In every crisis, Switzerland's rules worked while concentrated. Visible, illiquid wealth vanished. The pattern doesn't care about hope or optimism. It's mathematical. 3 nations, 3 collapses, 7 rules that worked every single time. And the acceleration should concern you, because conditions today mirror the warning signs that preceded historical collapses, but faster. Let me show you the 7 rules one more time, because these are the only financial principles that have survived every collapse in modern history. Store wealth in what governments cannot print. Gold, silver, Bitcoin, assets with fixed supply that no central bank can dilute. Own productive assets, not paper promises, businesses and real estate and farmland that generate value regardless of currency chaos. Diversify across borders, not just asset classes, multiple countries, and jurisdictions so single government failure doesn't eliminate everything. Never confuse a bubble with permanent wealth. Sell when everyone believes prices only go up because that's when risk peaks. Maintain liquidity through transitions, 20 to 40% in cash to buy collapsed assets when everyone else must sell. Decentralize everything, multiple banks and countries and currencies, so no single point of failure becomes catastrophic. Stay neutral, stay liquid, stay private. Don't bet everything on political outcomes and maintain legal structures that protect assets from visibility, that invites confiscation. China, 1948. The families who followed these rules maintained wealth while everyone else lost everything in 12 months. Japan, 1989. The families who followed these rules multiplied wealth by 10 times, buying the collapse, while everyone else spent 35 years recovering. Switzerland, 1850 to 2025. An entire nation built on these rules. 700 years of stability. While neighbors experienced war and depression and currency destruction. The mathematics of survival are consistent. In China's collapse, 90% of wealth vanished, but the 10% who followed these rules didn't just survive. They bought assets from the 90% at pennies on the dollar. In Japan's collapse, those with liquidity bought Tokyo real estate at 80% discounts, while those without stayed poor. In every crisis, Switzerland got richer while neighbors collapsed. We're not talking about whether collapse happens. We're talking about when. The U.S. follows the same pattern as every failing empire. Military overextension with bases in 80 countries. Currency debasement with 5 trillion printed since 2020. Unsustainable debt growing 1 trillion every 100 days. The difference between families who survive and those who don't is following these 7 rules before collapse becomes obvious. By the time everyone sees it, conversion is impossible. China, families had 12 months. In Japan, 3 years from peak to bottom. The pattern doesn't care about hope or exceptionalism or believing this time is different. You have 2 options. Option 1, keep 100% of wealth in one currency, one country, one system. Hope nothing breaks. Option 2, follow the 7 rules that worked in China, worked in Japan, work in Switzerland. 7 rules, 3 nations, centuries of proof. The question isn't whether these rules work. The question is whether you'll follow them before you need them. Because in every collapse in history, The time to prepare was before the crisis was obvious.